Welcome to The Explainer. You know, the stock market is full of hype and a whole lot of noise. Today, we're going to cut right through all of that. We're going to give you the foundational knowledge every single investor needs, looking at the common traps, and then, step by step, walking through how you can start researching a company all on your own.
Look, the idea of growing your money through investing is, well, it's really exciting, right? It's like you're setting off on this big adventure. But you gotta know, that path is absolutely filled with hidden traps that can trip up even the smartest people. Just knowing those challenges exist is the very first step in drawing your own map to success.
All right, let's dive right in with what is probably the single biggest mistake new investors make. Any guesses? It's letting your feelings call the shots on financial decisions. It is such a classic trap, and believe me, it is incredibly powerful.
Fear and greed. Those are the two big emotions that mess us all up. We've all been there, right? That knot in your stomach when the market drops, or that feeling of, oh no, I'm missing out when a stock is just skyrocketing. This is what leads to the classic blunder, buying high out of excitement and then panic selling low out of fear, usually because you're just following the headlines or what the crowd is doing.
So, what's the fix? How do you fight back against your own brain? It really comes down to this. You have to have a plan, and you have to stick to it. That means you need a disciplined long-term approach. You figure out your financial goals before you put a single dollar in the market, and then you have the guts to think for yourself, even when it feels like everyone else is running in the opposite direction.
Okay, let's build on that. Beyond just our emotions, there are a couple of other more subtle wealth destroyers that can really sneak up on you. First, putting all your eggs in one basket, and second, letting tiny fees just eat away all your hard-earned returns.
We've all heard the saying, don't put all your eggs in one basket. And yeah, it's absolutely true. Pouring all your money into one stock is just way too risky. But you know what? The opposite can also be a problem. Think of it like making a soup. If you only have one or two ingredients, it's kind of boring. But if you throw in 50 different things, all the flavors just get lost. It's the same idea with your portfolio.
The real key is finding that sweet spot. You want a portfolio that's well-rounded, with enough different investments to spread out the risk, but not so many that you can't even keep track of what you own. You need to build something that you can actually manage and that lines up with what you're trying to achieve in the long run.
Now, let's talk about fees, because these things are sneaky. Brokerage commissions, management fees for funds, the cost of trading all the time. On their own, they look like tiny, insignificant numbers, but over time, they add up. It's like a tiny, slow leak in a giant ship. You don't notice it at first, but eventually it's a huge problem that's been dragging down your profits the whole time.
The solution here is pretty simple, actually. You gotta watch those costs like a hawk. By picking low-cost platforms and looking at things like index funds or ETFs, which usually have much lower fees, you keep more of your money working for you. And that is how you unleash the real magic of investing, the power of compounding.
By the way, if you're finding this helpful, do me a favor and hit that like button and share this explainer with as many people as you can. And definitely drop a comment with the next topic you want us to dig into. Oh, and make sure you subscribe to Curious Decoder for more incisive, detailed analysis of everything you need to know.
It's so easy for people to just say, oh, do your own research. But what does that actually look like? Seriously, where do you even start looking for real unbiased facts so you can form your own opinion and not just follow the crowd?
All right, time to get our hands dirty. Let's walk through a real-world example. We're going to look at Nvidia, a company that's right at the heart of this whole AI boom. Now let me be crystal clear. This is not a stock tip. I am not telling you to buy or sell this stock. We're just using it to show you exactly how to find the kind of information that the pros use, information that's available to literally anyone. We are going straight to the source, the official report a public company has to file with the US government's financial regulator, the SEC, every single quarter. It's called a Form 10-Q. This isn't some analyst's opinion, it's not a news story, this is the raw data, straight from the company. And anyone, including you, can go online and read it for free.
So, what can you find in there? Well, check this out. This table, which we pulled right out of Nvidia's 10Q, breaks down where their money is coming from. Now, their graphics segment grew by 16%, which is pretty good, but the real story is in that compute and networking line. That's their data center and AI stuff. It grew by an unbelievable 112% compared to the year before. Right there, that tells you exactly where the company's insane growth is actually coming from.
But wait, good research also means you have to understand the risks, and companies are legally required to tell you what they are. Here's a perfect example. Nvidia themselves, in their own report, are saying that because they innovate so fast, they face huge challenges managing their supply chain, and that could make their revenue volatile. See, that's not speculation, that's the company's own assessment.
And there's more. The report also points out these huge external risks they're facing. Things like US government export controls that could seriously hurt their sales, or geopolitical tensions in Asia that could mess up their supply chain, and the fact that the whole AI market is facing more and more government scrutiny all over the world. This is the kind of critical stuff you don't always see in a news headline.
Okay, so let's pull all of this together. We've talked about the common mistakes people make, and we've seen how to find real primary source information. So what's the big takeaway? What does all this mean for your investment strategy?
Building a successful investment journey really boils down to these core principles. It's about being rational, not emotional. It's about diversifying your money smartly. It's about being totally obsessed with keeping costs low. It's about having the patience to stay in the market for the long haul. And it's about understanding how taxes affect your decisions. Honestly, mastering these is what separates the successful investors from everyone else.
So what's the bottom line here? Real investing isn't about getting rich quick. It's not a lottery ticket. It's a marathon, not a sprint. It's something that rewards patience, discipline, and making consistent, rational choices based on your own homework, not on what the market is screaming about at any given moment.
At the end of the day, the market is just this chaotic storm of opinions, hype, and fear. So the real question you have to ask yourself is this: are you going to let all that noise push you around? Or are you going to focus on understanding the real fundamentals and find your own clear signal in the middle of all that chaos? That's how you go from being just a speculator to being a real investor.